Welcome to Currency Archives. If you've been watching markets long enough to remember when a handshake meant something, when numbers on a balance sheet actually represented something physical, then you know why you're here. This isn't entertainment, this is documentation. Before we continue, do something simple. Press that subscribe button, not because of algorithms, but because when Tuesday arrives and these numbers start moving, you'll want to know you didn't miss what came next. And drop a comment. Tell us where you're watching from. New York, London, Mumbai, Singapore, because what's happening in silver markets right now doesn't respect borders. Now, let's examine what the data is actually showing. The silver market did something last week that shouldn't have been possible according to conventional wisdom. It rallied nearly 9%. That alone wasn't the anomaly. What made it structurally significant was timing. China, one of the world's largest consumers of physical silver, was completely offline. The Lunar New Year holiday shut down the Shanghai gold exchange, closed trading desks across Shenzhen and Beijing, and essentially removed Chinese demand from global price discovery for an entire week. Standard market logic suggested metals would struggle. When a major demand center goes dark, prices typically soften. Sellers remain active, buyers disappear. The imbalance should pressure prices downward. That's not what happened. Silver futures printed $84.57 by Friday's close. Gold reclaimed $2,900. Both metals moved aggressively higher, while Chinese markets sat frozen. The immediate question becomes obvious. If prices rise without one of the largest sources of physical demand, what happens when that demand returns? But that question, while important, misses the deeper structural issue the market just revealed. The data coming out of COMEX, the primary futures exchange for silver in the Western Hemisphere, showed something more concerning than a simple supply-demand imbalance. Registered silver, the category of metal that's actually warranted and available for immediate physical delivery against futures contracts, sat unchanged at 88.19 million ounces going into the weekend. No new metal flowed in. The February contract finished its delivery cycle. March now sits as the active month. And here's where the mathematics become uncomfortable. March contract open interest represents roughly 222 million ounces of silver. That's the amount of metal theoretically owed to contract holders if they demand physical delivery instead of cash settlement. Registered inventory stands at 88 million ounces. The deficit between what's owed and what's available for delivery exceeds 134 million ounces. That's not a tight market. That's a structural mismatch. Meanwhile, eligible silver, the broader category of metal sitting in COMEX vaults, but not immediately available for delivery, continued declining. Another 1.2 million ounces left the system in a single session. The roll from March to May contracts, the mechanism by which traders extend their positions into future months rather than taking delivery, moved at only 15 million ounces in one day. 4 trading days remain before March enters its delivery period. The math doesn't resolve itself. This isn't speculation. These are publicly available inventory reports updated daily by the exchange itself. Anyone can verify these numbers. Most don't bother looking. Those who do understand why the roll pace matters. If open interest doesn't roll fast enough into future months, the system faces a concentration of delivery obligations in March that registered inventory cannot fulfill. The exchange operates on the assumption that most contract holders will settle in cash or roll forward. That assumption works until it doesn't. What made last week's price action structurally revealing wasn't just the upward movement. It was that the movement happened while a massive source of physical demand sat completely absent from the market. Western futures markets, left to price silver without Chinese arbitrage, without Shanghai's physical delivery exchange providing a reality check on paper pricing, printed $84. The market discovered that price without Eastern participation. Now consider what was happening on the ground in China while their exchanges sat closed. A major silver recycling company in Shenzhen, one of China's primary precious metals trading hubs, was offering the equivalent of $93 per ounce to buy back 9999 pure silver bars. That's the physical bid inside China. Western futures, $84. Shanghai spot before the holiday, $86. Physical bid in Shenzhen with exchanges closed, $93. A $9 spread between paper contracts and physical metal. That spread exists for a reason. It reflects the reality that paper claims on silver have multiplied far beyond the physical metal available to settle those claims. It reflects transportation costs, premiums, and most importantly, scarcity. When Shanghai reopens Tuesday morning, that $93 physical bid meets an $84 paper price. The question isn't whether prices move. The question is whether the system built on paper claims can absorb what happens when physical demand reasserts itself against a backdrop of sustained inventory drawdown. Last week proved something critical. Silver moved higher without China. Tuesday reveals what happens when China comes back to a market that already repriced without them. There's a number that doesn't appear on trading screens. It doesn't flash across financial news tickers. Most investors never see it. 300 million ounces. That's the cumulative deficit, the gap between what the world produces from mines and what the world actually consumes, projected for 2025 alone. To understand what that means, context matters. Annual global silver mine production sits at approximately 800 million ounces. Everything extracted from the ground worldwide in 12 months totals. That figure. It represents the entire primary supply available to meet industrial demand, investment demand, and every other use for silver across the planet. A 300 million ounce deficit means the world will consume more than 1/3 of total mine production beyond what's actually produced this year. That metal has to come from somewhere. It comes from existing stockpiles, from recycling, from above-ground inventories built up over decades, from whatever physical reserves still exist in vaults, warehouses, and exchange depositories. And those reserves are depleting. This isn't year one of deficit conditions. According to the Silver Institute, the industry's primary research organization tracking global supply and demand fundamentals, 2025 marks the 6th consecutive year that silver consumption has exceeded new mine supply. 6 years. Each year, the world burns through more silver than it pulls from the earth. Each year, the gap grows wider. Each year, the remaining above-ground stockpiles shrink further. The mathematics are straightforward. If deficits averaged even 200 million ounces annually over 6 years, that's 1.2 billion ounces drawn from existing inventories. That's more than an entire year's worth of global mine production, simply gone. Consumed in solar panels that won't be recycled for decades. Embedded in electronics shipped to landfills. Locked into industrial applications where recovery is economically unfeasible. Silver, unlike gold, gets used. It doesn't sit in vaults waiting to return to the market. It disappears into products, infrastructure, and technology. The industrial consumption is irreversible on any meaningful timeline. Now layer in what's happening on the demand side. Solar panel manufacturing alone consumed roughly 200 million ounces in 2024. Projections for 2026 push that figure toward 250 million ounces as renewable energy installations accelerate globally. Every solar panel requires silver paste for conductivity. There's no commercially viable substitute at current technology levels. Electric vehicles require approximately twice the silver content of traditional internal combustion engines. Charging infrastructure, grid upgrades, battery management systems, all silver intensive. As EV adoption scales, so does structural silver demand that cannot be reduced without abandoning the technology entirely. Electronics manufacturing, medical devices, water purification systems. The industrial demand base is inelastic. These aren't luxury applications that disappear when prices rise. These are critical supply chain inputs where silver's unique properties make it irreplaceable. And then there's investment demand. Exchange-traded funds backed by physical silver have seen sustained inflows. Sovereign nations quietly accumulating precious metals. Retail buyers in markets from India to Germany purchasing physical bars and coins at premiums that continue widening above spot prices. When physical buyers pay $5, $7, sometimes $10 over spot price to secure metal, that premium signals something the spot price itself doesn't capture. It signals scarcity at the retail level. It signals that paper price and physical availability have diverged, which brings the analysis back to that $93 bid in Shenzhen. A major recycling company, an entity whose entire business model depends on buying physical silver, refining it, and reselling it, was offering $93 per ounce, while Western futures traded at $84. Recyclers don't pay premiums out of charity. They pay what they must to secure physical inventory they know they can move at higher prices. They operate on razor-thin margins in a commoditized business. A $93 bid means they have buyers willing to pay even more. That bid existed while Shanghai exchanges were closed. No official price discovery occurring in China. No arbitrage traders moving metal between East and West to close the spread. Just physical market participants transacting based on actual availability. The paper markets, meanwhile, continued operating as if infinite supply existed at current prices. Futures contracts traded hands, options, positions adjusted. Algorithmic systems executed trades based on technical indicators and momentum signals. The entire apparatus of modern commodity trading functioned normally. But underneath that digital layer, physical inventories continued draining. COMEX warehouses reported net outflows even as registered silver sat flat. Eligible stocks declined. The metal available for delivery against contracts continued shrinking while open interest, the total number of contracts owed, remained elevated. This is where rehypothecation enters the picture. In fractional reserve banking, a bank holds a fraction of deposits as reserves and loans out the rest. Multiple claims exist against the same pool of money. The system functions as long as depositors don't all demand their money simultaneously. Precious metals markets operate similarly. The same physical ounce of silver can be pledged, leased, and committed multiple times over through forwards, swaps, and various derivative structures. One bar sitting in a vault might back several different paper claims. The system functions as long as most claim holders don't simultaneously demand physical delivery. For decades, that assumption held. Most traders settled in cash. Most contracts rolled forward. Physical delivery remained the exception, not the rule. The paper market existed as a pricing mechanism disconnected from the physical settling mechanism, but when physical supply tightens sustainably, when 6 consecutive years of deficits drain the buffer stocks that made fractional reserve commodity trading possible, the assumption starts breaking down. Spreads widen between paper and physical, delivery delays appear, premiums rise at the retail level, and eventually someone asks for their metal. And it's not there. The supply-side constraints make the situation structural, not cyclical. Mining production has plateaued. No major new silver deposits are coming online. Existing mines face rising extraction costs, environmental restrictions, and geopolitical complications. Mexico, Peru, China, the largest producing nations, face internal pressures that limit expansion. Refining capacity represents another bottleneck. Even if ore exists, transforming it into 999 fine silver requires specialized facilities operating at near capacity. Meanwhile, demand continues accelerating. The energy transition isn't reversing. Technology adoption isn't slowing. Industrial consumption isn't becoming optional. And now, investment demand is layering onto industrial demand in a way that historically precedes violent price dislocations. What the market showed last week, silver at $84 without Chinese demand active, was price discovery in a Western-only market. What Tuesday's Shanghai reopening will show is what happens when the world's largest physical buyer re-enters a market that already moved and discovers the spread between paper and physical has widened to $9. That spread doesn't close gently. It closes through forced reconciliation between what traders think silver is worth and what physical holders demand to part with actual metal. The structural deficit guarantees that reconciliation is coming. Tuesday determines whether it starts now. Markets don't crash because something breaks. They crash because everyone realizes something was already broken. Tuesday morning, Shanghai reopens, and with it, a mechanism that has been absent from global silver pricing for an entire week becomes active again. Not sentiment, not speculation, physical settlement. The Shanghai Gold Exchange operates under rules fundamentally different from Western futures markets. It's not a derivatives platform where contracts can be perpetually rolled forward or settled in cash. It's a physical delivery exchange where every transaction must be backed by actual metal. When someone buys a contract on the SGE, they're not buying a financial instrument representing silver. They're buying silver itself. That distinction matters more now than it has in years. Western futures markets, COMEX in New York, LBMA in London, function primarily as pricing mechanisms. Physical delivery is possible, but it's the exception. The vast majority of contracts settle financially or roll into future months. Traders exchange price exposure, not metal. This structure allows for leverage. It allows for liquidity. It allows thousands of contracts to trade daily without requiring equivalent thousands of physical bars to change hands. It also allows for something else, disconnect. When paper claims multiply beyond physical supply, the futures price can diverge from the physical reality. As long as most participants settle in cash, that divergence remains hidden. The system appears functional because it hasn't been stress tested. Shanghai's physical-only structure provides that stress test constantly. Every contract that trades must clear with actual metal. Every buyer must receive delivery. Every seller must provide physical bars meeting exchange specifications. There's no rolling forward indefinitely. There's no cash settlement option that allows imbalances to persist. This creates an arbitrage mechanism. When COMEX futures trade at $84 and Shanghai physical trades at $86, that $2 spread represents opportunity. Traders buy metal in New York, ship it to Shanghai, and sell it for the higher physical price. That flow should theoretically close the gap. Except the gap hasn't been closing, it's been widening. Before the Lunar New Year holiday, Shanghai spot was already running $2 above Western futures. That spread existed with both markets operational, with arbitrage possible, with every mechanism that should equalize prices functioning normally. Now, after a week of Chinese markets being completely dark, physical bids inside China have reached $93. That's not a $2 spread. That's a $9 canyon. And Tuesday morning, when the Shanghai Gold Exchange reopens, that canyon becomes visible to every market participant simultaneously. Here's what happens mechanically. Chinese institutional buyers, banks, refiners, industrial consumers, and investment firms have been unable to transact for a week. Their demand didn't disappear. It accumulated, orders queued, purchasing requirements backlogged. Lunar New Year traditionally drives significant precious metals demand in China. Gifting gold and silver carries cultural weight. Retail buyers stockpile. Families purchase jewelry and bars. That seasonal demand pattern, delayed by the holiday closure, now releases into the market all at once. January import data, captured before the holiday shutdown, already showed China's silver imports surging. Physical metal flowing into the country accelerated even as Western futures prices remained relatively stable. That divergence, rising physical demand against flat paper prices, signaled the disconnect was growing. Now that pent-up demand meets a market where Western prices moved 9% higher during the closure, Chinese buyers return expecting to pay around $86 based on pre-holiday Shanghai levels. They find COMEX at $84, but they also find physical bids domestically at $93. The immediate question every trader asks, which price is real? The answer reveals itself through volume. When Shanghai reopens, if volume surges and prices immediately gap higher to close the spread with domestic physical bids, that confirms the Western futures price was artificially suppressed by the absence of physical settlement pressure. If, alternatively, Shanghai prices remain stubbornly below domestic physical bids, that signals internal Chinese premium expansion, a breakdown in the connection between exchange pricing and actual physical availability, even within China itself. Either scenario is structurally concerning. The first means Western paper markets have been mispricing silver by nearly $10 per ounce. The second means physical scarcity in China has reached levels where exchange prices no longer reflect ground-level reality. Both point to the same underlying condition. The physical metal isn't where the paper claims say it should be. Historical precedent exists for what happens when this recognition spreads. March 2020, as pandemic lockdowns began, gold futures briefly traded $70 below London physical spot prices. The spread inverted. Futures, normally at a slight premium to spot due to carrying costs, traded at a massive discount because physical metal couldn't be delivered to New York vaults to settle contracts. Planes weren't flying, refineries were closed. The physical settlement mechanism broke. The spread closed only when the exchange altered delivery specifications to accept London bars instead of requiring New York good delivery bars. The market adapted its rules to avoid a delivery default. Silver faces a different problem now. The metal exists. It's not a logistics failure, it's a quantity failure. There simply isn't enough above-ground, readily available silver to satisfy both industrial demand and the delivery obligations stacking up in futures markets. COMEX March contracts represent 222 million ounces in open interest, with only 4 trading days. Remaining before delivery period begins, only 88 million ounces sit in registered inventory available for delivery. The roll to May is moving too slowly to resolve the imbalance. If Chinese demand surges Tuesday and pulls additional physical metal eastward, that intensifies pressure on COMEX inventories already stretched thin. Here's where central bank behavior becomes relevant. China's official gold reserves have increased for 16 consecutive months according to People's Bank of China disclosures. Each month, incremental tons added to state holdings. That accumulation signals a deliberate strategy to diversify away from dollar-denominated assets and build hard asset reserves. Silver doesn't receive the same official disclosure, but market participants observe parallel patterns. State-backed entities purchasing through commercial channels. Refinery output flowing into domestic stockpiles rather than export markets. Behaviors consistent with accumulation strategies hidden beneath the surface of public data. If Tuesday's reopening coincides with renewed state-level buying, even indirectly through state-influenced commercial entities, that demand hits a market already running structural deficits and facing delivery pressures in Western exchanges. The JP Morgan position adds another layer. For years, the bank accumulated physical silver while simultaneously holding large short positions in futures markets. That seemingly contradictory stance made sense if the strategy was to suppress paper prices while building physical inventory at artificially low levels, then profiting when physical reality eventually forced prices higher. Recent data suggests those short positions have been substantially reduced. If the accumulation phase is complete and the bank has transitioned to a long physical stance, Tuesday's Chinese demand surge aligns with rather than opposes JP Morgan's positioning. That's not conspiracy theory. That's recognition that sophisticated capital sees the same structural data everyone else can access and positions accordingly ahead of inflection points. Tuesday doesn't create the structural shortage. Tuesday reveals whether market participants recognize it exists. If Shanghai gaps higher, if volume explodes, if arbitrage flows reverse with metal moving from west to east faster than replacement supply can arrive, then the mechanism of price discovery shifts. Physical availability becomes the governing constraint. Paper claims become secondary. And the market reprices not based on futures algorithms, but based on who actually has the metal when someone demands delivery. 4 trading days remain until March delivery period. 1 week of accumulated Chinese demand releases Tuesday morning. And a $9 spread between paper and physical waits to be reconciled. The mechanism is in motion. Tuesday simply makes it visible. Every business decision rests on assumptions about costs, about supply chains, about the stability of the currency those costs are denominated in. When those assumptions break quietly, not in a single dramatic event, but through incremental shifts that compound over months and years. Most decision makers don't notice until it's too late to adjust. Silver at $84 isn't a price, it's a signal. And what it signals has implications far beyond precious metals markets. Start with what hasn't changed. Global debt levels continue expanding. The United States carries debt to GDP ratios exceeding 120%. Japan surpasses 250%. European sovereigns, emerging markets, corporate balance sheets, the entire architecture of modern finance operates under debt loads that require perpetual refinancing at manageable interest rates. When rates were near zero, that structure functioned. Debt could be rolled forward indefinitely. Governments could finance deficits without triggering market discipline. The assumption held that monetary expansion wouldn't create inflation because globalization, technology, and spare capacity would absorb liquidity. That assumption died somewhere between 2021 and 2023. Inflation surged. Central banks raised rates. And now the system faces a contradiction it cannot resolve through policy alone. Debt levels require low rates to remain serviceable. Inflation requires high rates to remain contained. Those two requirements are incompatible. The resolution comes through debasement, not announced debasement, not policy statements declaring currency depreciation as official strategy, but operational debasement through the mechanics of deficit spending, quantitative easing reintroduced under different names, and the slow erosion of purchasing power that allows debt to be repaid in money worth less than when it was borrowed. Silver's role in this environment is dual. It's an industrial commodity experiencing genuine physical shortages, and it's a monetary metal with a 5,000-year history of preserving value when fiat currencies debase. Both narratives are converging simultaneously. For business leaders, this creates strategic calculations that traditional financial planning doesn't address. Consider a manufacturing company that uses silver in its production process. Electronics firms, solar panel manufacturers, medical device companies, entities where silver is a direct input cost. At $20 per ounce, silver represents a manageable line item in cost structures. At $50, it requires procurement strategy adjustments. At $84, it becomes a critical constraint that can determine whether certain product lines remain viable. And if the structural deficit continues, if 300 million ounces annually gets consumed beyond mine production, prices don't stabilize at $84. They continue rising until demand destruction occurs or new supply emerges. New supply isn't coming fast enough. Mining projects take years from discovery to production. Permitting, environmental reviews, infrastructure development, financing. The timeline from identifying a deposit to extracting ore at commercial scale spans a decade or more. Existing mines face depletion curves. The easy high-grade deposits were mined generations ago. What remains requires processing more ore for less metal at higher energy costs. Recycling provides some supply, but industrial silver embedded in electronics and solar panels won't return to the market for 20 to 30 years. The metal is functionally removed from circulation for decades. This means the supply-side response to higher prices will be slow, insufficient, and unable to close the deficit gap in any time frame relevant to current business planning. For entrepreneurs, building companies dependent on silver inputs, this isn't abstract economic theory. It's an operational risk that must be hedged or managed. Hedging through futures contracts works if counterparties can deliver physical metal when contracts mature. If COMEX can't fulfill delivery obligations, if registered inventory remains insufficient, and the exchange shifts to cash settlement or alters specifications, then paper hedges fail precisely when they're needed most. Physical inventory hedging, actually purchasing and storing silver ahead of production needs, ties up capital and creates storage costs, but guarantees supply availability. In an environment where physical scarcity is the governing constraint, that guarantee may be worth the carrying cost. The alternative is production halts when metal isn't available at any price. Now shift perspective to capital allocators. Traditional portfolio construction relies on the 60-40 model. 60% equities for growth, 40% bonds for stability and income. The model assumes bonds provide ballast when stocks decline because interest rates typically fall during recessions, lifting bond prices. That correlation broke when inflation emerged. Stocks declined in 2022, bonds declined simultaneously. The diversification benefit disappeared because both asset classes responded to the same underlying force. Central banks raising rates to combat inflation. In that environment, hard assets behaved differently. Commodities rallied, energy spiked. Precious metals remained resilient even as financial assets sold off. The lesson wasn't that hard assets always outperform. The lesson was that when currency debasement accelerates, when the real value of cash and bonds erodes through inflation, assets with intrinsic utility or scarcity hold value better than paper claims on future cash flows denominated in depreciating currency. Silver sits at the intersection of scarcity and utility. It's scarce due to sustained deficits and depleting inventories. It's useful in technologies central to the industrial economy. And it carries monetary properties that activate when confidence in fiat currencies deteriorates. Institutional capital is beginning to recognize this. Central bank gold accumulation has been documented extensively. State actors diversifying reserves away from dollar assets and into hard assets with no counterparty risk. Silver doesn't receive the same official disclosure, but flows are observable. ETF holdings fluctuate with investment sentiment, but physical bar and coin demand remains elevated even as prices rise. Premiums over spot persist at retail levels. Mints report sustained orders. Dealers struggle to maintain inventory. These aren't signals of speculative excess. Speculative excess appears in leverage, in derivatives volume exploding, in margin debt expanding. What's appearing now is accumulation, steady, patient, non-leveraged purchasing by entities that intend to hold physical metal as a strategic reserve rather than trade it for short-term gains. When sovereign wealth funds, family offices, and long-term capital allocators move into an asset, it signals a view that extends beyond quarterly earnings or election cycles. It signals a structural reassessment of risk. The risk being reassessed isn't market volatility, it's systemic fragility. The recognition that debt levels, monetary policy contradictions, and geopolitical fractures create conditions where traditional safe assets, government bonds, reserve currencies, financial system deposits, may not function as expected during stress events. Tuesday's Shanghai reopening serves as a micro-stress test, not of the entire system, but of one specific mechanism, whether paper claims on silver can be reconciled with physical availability when a major demand center re-engages after absence. If that reconciliation occurs smoothly, if prices adjust modestly, if volume absorbs the demand, if inventories shift without disruption, then the system demonstrates resilience and the structural concerns remain theoretical. If reconciliation is violent, if prices gap significantly, if delivery delays appear, if spreads between paper and physical widen further rather than close, then the stress test reveals fragility that extends beyond silver into every commodity, every futures market, every derivative structure built on the assumption that paper and physical remain tethered. For business leaders, the implication is directional, not predictive. The implication is that supply chains dependent on commodities experiencing structural deficits face rising input costs and potential availability constraints that financial hedging may not fully offset. The implication is that capital preservation strategies, relying exclusively on financial assets, denominated in currencies being actively debased, carry risks not captured by traditional volatility measures. The implication is that diversification into hard assets with genuine scarcity and industrial utility provides portfolio ballast that correlates differently than stocks and bonds during monetary instability. This isn't a recommendation to abandon equities or liquidate portfolios into physical silver. It's recognition that the economic environment has shifted. Currency stability is no longer guaranteed. Debt sustainability is increasingly questionable, and the mechanisms that allowed paper claims to trade disconnected from physical reality are being tested in ways they haven't been tested in generations. Tuesday doesn't answer whether those mechanisms survive long term, but it reveals whether market participants are beginning to question them, and in markets, once enough participants question the foundation becomes the trade. Silver at $84 with China absent was the market pricing without physical settlement pressure. Tuesday brings physical settlement pressure back, and the business community watches because what happens to silver when paper meets physical scarcity eventually happens to every asset built on leverage, rehypothecation, and the assumption that claims always equal delivery. The strategic question isn't whether to panic, it's whether to prepare, and preparation begins with recognizing that what looks stable may only be stable because it hasn't been tested yet.